Our colleague Aleg Hogg sat down with Paul Kaplan, global risk expert, quantitative research at Morningstar in Canada, about the importance of value investing. Let's take a look.
We have a great debate going on in South Africa about active versus passive managers and who outperforms whom. Morningstar must have done lots of analysis on it. You're a mathematician. Give us the definitive answer.
Well, first, I'm not a mathematician.
Well, you studied maths, according to your CV.
Yes, that's right. I did study math. So the question is
who wins? Active, passive?
I think there's this room for everybody. There's a big.
But who's outperforming?
It's not. There are some active managers who have historically been very successful at outperforming. There are certain active managers whom Morningstar believes is well set to outperform for a number of different reasons, based upon the parent company, the process that they use, the managers, the prices that they charge, and so on. So
what percentage of total active managers would fall into that category?
I really don't know. I really
10, 15, 20, 50, 60, 100?
Less than 100.
Less than 100. Paul, you're boxing a little bit clever here.
Yeah.
We believe, or we are believed to understand, that only 30% of active managers in any one year will outperform the index.
But
is that accurate?
Well, I don't know offhand. I mean, this is the kind of thing I would have to go back and crunch numbers for, or check with someone who has. But I think the important thing, the way you set that up, was you said in a year. And I think one of the biggest mistakes investors make is saying, oh, how did this fund do over the past year versus the other ones? Because this year's winner could be next year's winner, loser, and vice versa. So we believe that investing really should be done for the long run. If you're going to be investing in risky assets, such as equity mutual funds or ETFs, you really need to be in it for the long haul. And you really need to have a strategy or subscribe to a strategy that you have good reason to believe will outperform over the long haul. One of the biggest mistakes that investors make, and this we've done studies on, is the tendency to chase performance. And there are two ways we can measure the performance of a fund. Number one, we can measure what's called its time-weighted return, or its total return, and that's what you'll always see on the reports. This fund did this over the past 3 years, had a 5% performance. Over the past 10 years, had a 10% performance or whatever. The other number is the money-weighted return, and this is a measure of how the individual investor did with that fund. How well did they? Not just how well the fund did, but it depends on how well the fund investor used it. Now, some of the studies that we've done, of course, we don't have the data on the individual investors. We only have data on investors as a group in each fund. So we know what the assets were over time in the fund, and we know what the cash flows over time. And what we find is that, for many funds, that investor return, as we call it, is falling behind that time-weighted or total return. So, unfortunately,
so how do you unpack all of this for man in the street? He wants to have a retirement funding into the long term. What does Morningstar or Dr. Paul Kaplan suggest he does?
Put together a well-diversified portfolio that's been designed to meet your financial goals. If you can get to a financial planner to help you with that, so much the better.
What about a robo-advisor?
Or a robo-advisor that's well constructed.
That's big stuff now, isn't it, in North America?
Oh, yes, and yes, it's becoming very big. And in fact, Morningstar, it's a space that Morningstar is in the retirement space in the United States.
So you can go online, put in your details, and the robo-advisor will tell you exactly how to allocate your assets.
It will, yes. And if the robo-advisor is well constructed, it will take into account, a number of different factors. How old you are, how much income you're going to get, how much government insurance you're going to be receiving, once you retire, what other assets you might own, and it will come up with an advice.